Welcome back. Still in conversation with Prakash Diwan. Prakash, I don't know if you caught the commentary that we got from the Gail management on the channel today. We were talking to them about this Magalore-Kochi pipeline. Stocks had a good run. They're talking about, of course, incremental volumes coming in over the next couple of months. What's your view?
Very positive. Even the other day when we were talking about themes that seem promising and going into the budget, there's this whole wave of PSU re-rating that's underway. And GAIL is one asset that I had explained. And this was just a day or two before the Kochi refinery pipeline got inaugurated by our Prime Minister. It is an asset that will probably benefit so much by the kind of end user industry moving up. And this unified tariff regime has actually been a big blessing of sorts. It's been on the cards for a long time. And finally that it's happened. You will probably start seeing the operating leverage move from the balance sheet to the P&L. So that's the kind of move that I think GAIL is ready for, and that's exactly why you see it getting lapped up at every dip, whether it was a week back on Monday and now even today, yesterday. So it has that strength, and I would believe it should do very well in the next year or so.
Okay, Prakash, we will leave it there today. Thanks a lot for joining us. Let's get back now to the market and address some more issues. We have Pramod Gubbi now joining us, co-founder of Massless Investment Managers. Pramod, good afternoon. Been a strong run, right? And I guess a lot of people are asking how long can this continue? Are we at the 2003 to 7 phase? Perhaps not exactly at that phase, but somewhere in the, say, first 25% of that move. Your thoughts?
Well, I think predicting the future has always been a challenge. It's increasingly more so given what's happened over the last few months and the sort of world that we live in, which is clearly has a big artificial market participant amongst us, which is the central bank. So we're still not in a stage where we're saying market is driven by natural drivers of earnings or fundamentals in general. So it all seems to be seen as to when the liquidity is pulled out, how the markets behave. I think eventually the markets will have to converge towards the underlying fundamentals. And focusing on the underlying fundamentals, I think, again, focusing more on India, which is perhaps closer home, I think we're in the beginning of a reasonably strong economic recovery. India has always thrived in periods where money is being cheap, which is clearly the case today. And oil prices, albeit recovering somewhat, but it's still in a very comfortable zone, which has its own ramifications on the fiscal deficit, which has its own consequences in terms of how the government can continue sustaining this recovery. Therefore, I think we're in a good spot as far as an economic recovery is concerned. Will it be as grand, particularly in terms of the investment cycle or the capex cycle picking up as much as 2003 to 2007? I'm not so sure. I think there are still a whole host of supply side bottlenecks that need to be put aside for a more sustained investment cycle recovery. But for starters, I think the consumption will lead that recovery. And as you see utilization levels building up, there will be some sort of a capex cycle recovery. And at least for the next 3 to 5 years, I think we're on a strong wicket. And to that extent, if you're invested in companies which can benefit from this underlying recovery, you're bound to end up with a reasonably strong outcome.
Okay. Pramod, first of all, Happy New Year to you. Greetings of 2021. Now, I want to ask you about, some of the big lenders that you have in your portfolios. For instance, let's look at Bajaj Finance as an example. A lot of these lenders have been telling us about their Q3 update just ahead of the result season. Now, a stock like Bajaj Finance has seen a dramatic recovery from the March lows. But if you look at the numbers today, for instance, their book is still down 1% year on year. So growth hasn't really returned as quickly as the recovery in the stock price. So how do you sort of marry the two when you're looking at the big banks and the NBFCs in your portfolio?
Well, I think there are two ways to look at it. One is the here and the now. The here and the now, you're absolutely right. The stock price is back to pretty much what its original levels were pre-COVID. And so is the AUM. The AUM might be slightly 1% down, like you said, but by and large, it's in line with where we were before COVID. So dramatically, there isn't much of a difference either in the stock price or in the fundamentals. However, if you look at it with the context of what's happening in the NBFC space in general and the competitive forces at play, I think Bajaj Finance is actually in a much stronger position today than where it was 12 months ago. For starters, there's massive excess liquidity on the balance sheet, right? So there's massive dry powder in case there is a recovery in loan demand. Bajaj can actively participate without having to access capital at all. Secondly, its access to funding is clearly significantly lower, particularly its funding costs, either in the wholesale markets, and more importantly, Bajaj has had a structural advantage in the form of access to retail deposits. Whereas most of its other NBFC competitors who've relied excessively on wholesale markets for funding are struggling today. So from a competitive standpoint, I think Bajaj is much stronger than where it was pre-COVID. And if the recovery were to sustain in terms of loan demand, Bajaj is likely to end up with a stronger or larger share of that recovery. So to that extent, we are happy holders. We did buy quite significantly in the fall in April and May, and should it were it to fall again, we'll be more than happy to top up our position.
Okay, correct me if I'm wrong, Pramod. I think you have a large exposure to alkyl amines, right? And that's been, of course, a serious wealth creator, and it's gone up 40% in 2 days. Just because they are considering stock split. But tell us if you are in it for the long haul, you think this is a long-term story?
No, it is indeed. Again, we do get nervous when stock prices react so strongly in such a short period of time. But we have the luxury, given our clients have given us a longer-term mandate, we have the luxury of taking a longer-term view, and the longer-term fundamentals are getting stronger and stronger. Again, this is one of those industries which is effectively a duopoly in India, with very scarce access to raw material, a significant advantage in terms of technology, particularly the chemistry knowledge the company possesses. And it's ideal given the underlying tailwinds around pickup in pharma and chemicals, specialty chemicals and APIs, for which alkyls products are an input. It's in a sort of a sweet spot where you have the market opportunity intact and hardly any competition left. So if you take a relatively longer-term view, longer-term we define as 3 years and beyond, I think it's still a great company to be in. We continue to be happy holders, notwithstanding the recent rally in prices, which could scare some people, particularly from a short-term perspective.
By the way, interesting move on Shree Cement. The stock has been range-bound for the last couple of days. Right now, it's kind of spiking higher, 2.5% up. It's one of the better performing stocks on the Nifty today. So I'll make that my final question. You have your twin filters of high ROAS and high revenue growth, Pramod, at Marcellus, I guess. So since the market is looking for a lot of plays on the economy, if this is a real economy turn, then any new themes, anything new that you guys are looking at?
You're absolutely right. I think building materials in general, whether it's cement, paints, adhesives, and so on, are clearly in a sweet spot. We are seeing a recovery in the housing market, and more importantly, some of these also play into replacement demand as well, and therefore there is a strong underlying demand at the beginning of the cycle, which can sustain over the next 3, 4, 5 years at least. And within these, if you can find companies, unfortunately, we still haven't had the chance to buy into a company like Shree Cement. It's a fantastic company which has demonstrated significantly strong, sustainable competitive advantages over long periods of time. But I think there are a handful of building material companies which are very closely tied to the fortunes of the economy. And if the economic recovery were to sustain, which is our base case scenario, several of these well-run building material companies can do well in terms of earnings growth, and therefore the return should be fairly handsome over the next 3 to 5 years.
Okay, fair enough. What about IT, Pramod? That's had a one-way rally. But are you adding any more names in your portfolio from the IT pack?
No, I think we own TCS amongst the IT names. We also own InfoEdge, which is not particularly the same league as the traditional IT services model. And we've been quite happy with the fundamental performance of both these companies. And I don't see any reason why we should add any more names, given both of them have given us the exposure to the underlying trends. Having said that, I think given where the U.S. economy is, given likely excess liquidity causing some sort of dollar depreciation, you may not get that with tailwind in terms of the rupee depreciation giving you a boost for earnings growth. But then, that's beyond our realm. Locally, also inflation is picking up, so there could be a case for that reversing as well. But fundamentally, what TCS has done in terms of building the skill sets, building the capabilities to address the new digital world, and also take on the threat from automation in software programming is fairly commendable. So we remain quite happily exposed to these two companies in IT.
Okay, you said you have InfoEdge. What exactly is driving this move in InfoEdge, Pramod? Is it Zomato? Is it something else? Or is it just the market's craze perhaps for some of these companies?
I think there's an element of scarcity as well for the Indian investor. You can look around what's happening in America and China, and several digital companies have built massive businesses, both in terms of bottom line as well as market cap. Unfortunately, in India, we don't have too many opportunities there, and therefore there is an element of scarcity value. Having said that, I think it's in line with what's happening in the economy as well, and the pandemic seems to have accelerated that transition to digital businesses, and InfoEdge has a finger in each of those pies in multiple end industries which are being digitized quite at a furious pace. Zomato being one of the I think poster boy examples, but there's also Policy Bazaar, its own Naukri, and I think the market is just reflecting these two aspects: the fact that there are not too many pure play digital companies in India. At the same time, InfoEdge is gotten its capital allocation right by finding some of these opportunities and have invested over the years, which are now becoming market leading.
Pramod, we will leave it there today. Thanks a lot for joining us, and have a good 2021.
You're welcome.
That's the view from Marcellus. Well, look at the market, by the way. Once again, third day running, it's happened that the market's given you an intraday plunge. And that plunge has been used to buy, and specifically on the Bank Nifty, where we are once again back above 31,800. ICICI Bank is really the strong stock over there, and has been for 2 days now, both ICICI and Axis. So yesterday Axis outperformed, today it's ICICI Bank which is outperforming at high point of the day. So we spoke about sheer cement. In fact, it's entire cement pack. If you look at what's happened to Ultratech, ACC, Ambuja, it's a telltale sign perhaps that the selling has abated in cement stocks, has come to an end, and that's what you're seeing right now. Look at all these charts. ACC, Ambuja, Ultratech Cement. Shree, of course, is leading that move, but others are also doing well. And keep an eye on IGL as well. 542 now on that stock. It's been a big mover. We'll take a break. We'll come back with dealing room check in our segment D Street Chatter.
And also trading calls for the last half hour coming up with Nitesh.